Hello, today I have with me Matthew Superior, real estate analyst at Peel Hunt. Hi Matthew, thanks for joining me today.
My pleasure.
UK real estate firms are very much out of favour at the moment. Could you explain why and give us an overview of market conditions in the UK commercial property sector?
Absolutely. I think of the commercial property sector as very much a tale of two markets at the moment. Occupationally, many parts of the market still see good demand for space. Rents are rising. Yet when you look at the investment market, clearly something else is going on. We saw values fall 20% in the second half of last year on the back of obviously the change in the macro environments. We've seen a bit of value stability in the first quarter of this year and into the second quarter, but clearly given the recent changes in interest rates, and swap rates are up 160 basis points in the last 3 months alone, we suspect there might be a little bit more downside in values to come through the remainder of this year.
I was going to say, what's the outlook for the second half of 2023 and beyond? I mean, when do you see discounts narrowing perhaps to historical norms?
Yeah, the $64,000 question. Well, I think we are at the mercy of the macro at the moment. A chart that we're showing lots of our clients at the moment is one that maps the sector share price performance with that of the 5-year swap rate, and the correlation over the last 12 months is 0.9, the highest it's ever been. So effectively, equity investors are saying, we'll buy real estate when swap rates go down and we'll sell real estate when swap rates go up. So until we have a bit more clarity on the interest rate environment, the economic environment here in the UK, I think calling the real estate cycle is still going to be quite a difficult thing to do. But of course the equity market has already done that. It prices real estate shares in real time. So as we sit here today, the sector is trading at a 33% discount to last reported net asset values. That we think implies about a 22% haircut to underlying property portfolio values. And that obviously follows the 20% decline that we saw in the second half of last year, which is already reflected in the company's net asset value. So the peak to trough fall in asset values being implied by equity prices is pretty significant.
I know we could play sort of the game of what if, but I'm going to ask you, say interest rates go up another 50 basis points before the end of the year, so inflation stubbornly high like it seems to be, what would that mean, do you think, for commercial property?
Yeah, so we always think about yields on properties in the context of sort of a medium to long-term interest rate. So we don't necessarily look at base rate, we'll look at a 5-10 year swap, maybe even a gilt. Typically companies, when they fund real estate, they'll do that on a medium to long-term basis. So that's our benchmark. So we're already looking beyond the imminent increases in base rate when we're sort of trying to put pricing into context. If I go back to that 22% discount to gross asset values that the sector's currently implying, if you look at that on a yield basis, that probably means that market yields are going to move out another 160 basis points, or at least that's what share prices are implying. And actually, given the move that we've already seen, putting that on top of it actually gives you still a very comfortable spread over prevailing, medium-term funding rates.
Okay, well look, I mean, what about refinancing risks? Is this likely to be a major issue for the sector, do you think?
I think more widely there is clearly, a lot of capital employed in real estate, both debt and equity, and clearly we've enjoyed, cheap debt for quite a number of years, and that has come to an end. I think one of the very positive attributes to the quoted sector, the companies that I look at, is that we've been very prudent in terms of the quantum of debt that we have used, certainly in the period post the global financial crisis. But we've also been very prudent in making sure that in the vast majority of cases, we're using debt that has, maturities of, 5+ years. So the refinancing risk in my coverage universe is pretty minimal. Actually, when I look at our own maturity profile against that of the wider market that other commentators sort of tot up, about 40% of our debt book expires beyond the next 5 years, and that's more than twice the wider market. So the wider market might have some refinancing to do in the short to medium term. The quoted real estate sector has considerably less.
Okay. Well, despite the headwinds, investors will be asking, well, is this a good time to consider exposure to the commercial property sector? That might be sort of that first, dipping their toe into the water for the first time, or existing sort of shareholders buying more.
I'm cautiously optimistic and have been this year, and I think there are a number of reasons why I'm cautiously optimistic. I think it's always good to be slightly contrarian, and clearly you pick up a newspaper, it's about interest rates, it might be about people working from home, it might be about refinancing of real estate. Those headwinds from a real estate sector are probably still going to continue. You've clearly got some pretty significant macro headwinds as well, certainly in the near term. And interestingly, equity investors have voted with their feet as well. So there was a recent survey, and real estate as a sector, I think, is the most underweight it's been since 2009. It's the most underweight sector amongst equity fund managers. So as a contrarian, I look at that and go, okay, well, hopefully at some point those headwinds ease. At some point, the underweight has to be closed. And on top of all of that, as I've already said, you can buy real estate today at a price that's probably 40% lower on the share price, implied pricing, than it was 12 months ago. So you might think I'm buying ahead of the more optimistic view on the macroeconomy. I'm buying ahead of people starting to close their underweight positions, and I'm doing so at pricing that looks like it's at or near some sort of cyclical low point as well. So, those things to me make me think that actually, if you're buying real estate here, and real estate is always a long-term investment, I think that's always very key to make the point, is that you don't buy real estate because of what it's going to do in the near term. You're buying it because of the medium to long term, hopefully growth, income that it provides, and doing so at a low point seems to me to be quite a sensible thing to be looking at.
Okay, well, with cash-like investments and bonds, that they're currently offering the highest yields for over a decade, how would you convince an income-seeking investor to back property over those two other options?
Really good question, and I think real estate, and certainly in a quoted wrapper, was almost the only game in town for a number of years for investors to get income, and clearly that is no longer the case. I think what I would point out to people is that real estate income, you should get an element of growth with that you don't necessarily get by putting your money in the bank or buying fixed income. And again, when I look at the quoted sector and look at the underlying real estate and the subsectors that we're exposed to, actually a lot of the real estate that we own in our sector is in structurally supported categories, and therefore I still feel quietly confident that there is going to be a really good rental growth story. You might have heard of the term beds, sheds and meds, to sort of encompass the growth sectors of industrial, of student accommodation and purpose-built residential and primary healthcare. I think when I look at it, it's about 50% of our underlying real estate is probably aligned to those sectors. Another 25% is either in high-quality London offices or West End mixed-use real estate, and I still feel very confident, again, on the medium to long term, those are going to be sectors where you can get demand and supply driving rental growth from the underlying assets.
So, Matthew, what might the yield be for the average yield for the sector at the moment?
So, on the underlying real estate, on a last reported basis, your initial yield is probably still beginning with a 4. Your equivalent yield is probably 100 basis points higher than that. Of course, as I said earlier on, what's being implied by share prices is significantly higher than that. And then to the actual investor, your dividend yield today at the sector is probably north of 5% and well covered.
Okay, so if an investor's interested in the commercial property sector, I mean, they'll be interested to know what your favourite route into the sector is. What should they be looking for once they've decided they want to invest?
I would say this, but I'm a very strong advocate of investing in quoted real estate companies, and I think that I'd argue that the positive attributes we have are more important than ever, and those are strong management teams, access to capital, prudent use of leverage, but also that underlying exposure to structurally supported growth sectors. So quoted real estate, I think, is an excellent place to be. Clearly, the pricing today provides you with an opportunity to buy in significantly below net asset value. I would be looking at those supported growth sectors. So, as I said, the beds, sheds and meds. I think self-storage is another fantastic part of the market. High quality London offices, particularly those companies that have a track record of developing, repositioning, refurbishment, and as the flight to quality amongst office occupiers continues, those sorts of skill sets and the product they're creating can only ever get, I think, more sought after.
Fantastic. Matthew Superior, real estate analyst at Peel Hunt, thanks for joining me today.
My pleasure, thank you.